Hi traders, welcome to the live webinar with Admiral Markets. My name is Chris. Happy to see you here. Today's focus is on strategy. I'll be taking a look at trading retracements and continuation patterns within the trend. So looking forward to do that. Before we kick off this webinar though, please note the following disclaimers. First of all, that this webinar is shown to a global audience but may not be suitable for everyone. Please visit animalmarketsglobal.com, select your country of residence, and contact the appropriate entity to find out more and to find out if it is suitable for you. Also, please note that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risks involved when trading. All right, so if you're perhaps new in this webinar, perhaps new with Admiral Markets, and you're wondering what it's all about, well, first of all, a quick introduction. Admiral Markets, you can find out at admiralmarkets.com a lot of info about how to start trading, for instance, opening a demo account, but also what kind of financial instruments you can trade, what kind of platforms you can use, including the extra edition, Supreme edition that Admiral Markets has made for MT4 with a lot of extras. I'll show a few of them in the upcoming webinar. As we take a look at the live markets, just hang on 1 second. As I explained, that there's also analytics and education. So a lot of good stuff here, I think useful stuff and information. So I would definitely encourage you to take a look. If you are relatively new to these webinars, I also encourage you, and also if you've been here longer, gladly welcome all of your comments and questions, etc. So looking forward to that. You can use the chat box to do that. I'll be taking a look at the forex markets, some commodities, some stock indices, anything you have in mind. I'll gladly take a look. In the meantime, first of all, a quick look at my charts that I have with the wave analysis. And I wanted to take a look at that because you can see that I was expecting a reversal on, well, not a reversal, but at least a bigger retracement in the euro dollar. And I'm happy to say that at this moment, at least the 117 target has been reached. So I'm glad with that. I always warn for reversal retracement ideas because typically it's difficult to catch reversals. Trends tend to go further than you expect. This is one of the reasons why I wanted to make a specific a topic specifically focused on trends, because I think it's important to not to lose focus. I don't think there's anything wrong with reversal trades, by the way, but I just want to kind of put our feet on the ground and say, okay, reversals do happen, but you want to definitely be on guard and you want to be critical about when you could expect that, when it's realistic, and think maybe more deeply about when you take reversal setups. When I take reversal setups, I did take a reversal setup or retracement setup on the euro dollar. I definitely thought that the euro dollar was an uptrend. I've been talking about that ever since price broke 113, even discussed some upside potential before that, but that was still more bearish environment. 113 was a crucial level in my view, and indeed continued to 120. I was definitely bullish, looking for upside trades. And that's great. And I think that there are probably plenty of reversal traders that were looking for downside trades way earlier than that. But I had targets in mind: 115, 117.50, 120. Every time price breaks above these resistance levels, we could expect the trend to continue. And it's better to look for retracements within the trend and continuation patterns within the trend than to look for reversals. So I don't want to be too harsh on reversal traders, don't get me wrong. It's just that from my experience, it's been more profitable to look for retracements and not necessarily ignore reversals, but not continuously look for them either. When they're there, they're there. But I'm looking for more confluence before I take a reversal. The euro dollar is such an example. It's one of those trades I did take to the downside, despite that the trend is still down. But because price reversed here with NFP, I expected a follow through to the downside. I talked about that on Monday and Tuesday. I wasn't sure if it was going to work out. That was just my best analysis. In this case, it did work out, and I'm happy with that. I made, I can show you the trade in just a second, 95 pips on this trade to the downside. Now, 117, I think, is only an intermediate target. If my analysis is correct, I expect price still to fall down to 116, which is a 23.6 fib of the wave 4 versus 3. So this is based on wave analysis, which is a different matter. I don't want to dive into that right now. But what is good to know when trading with the trend is using fibs. And what I did is I put a fib on the wave 3. You don't see this entire wave 3, but basically I put it on, and I can show it to you on the live chart now. That is a bit messy. Let me, on this daily chart, let me get rid of, or let me just quickly, sorry about that. Let me move the time frame here a bit so you can see that a bit better. Let's see. I think, one second. Let me, seems to be a bit slow. Let me close something here in the background. All right. Let's see if that helps. All right. So I'm looking at the daily chart, and I basically put the fib from this spot at 106, 105, 70, 60, all the way to the top, and basically I think that the 23.6 fib could be one of the bouncing spots. It could even go further, maybe to 114, which is the 38.2 fib. All right. So that is something that I think the retracement could still continue. Now, I'm not sure how fast the charts seem to be a bit slow with updating. So I'm not sure if, okay, there's a bit of delay there, but okay, I'll try to keep an eye on that. In any case, uh, so yeah, trends. Trends are important, and I think it's very good to focus on trends. So let's talk a bit about more how trends can be traded. I think that reversal trades like this one do occur, right? But they are more exceptional. And you got to be more careful and pick your battles more wisely and carefully. This euro dollar, in my view, as you can see, I entered here and I exited right at the S1. That was my target at 116.92, and price went to 116.88. So, and then bounced pretty strongly. So, happy with the target. Entry, okayish, went a little bit against me, but then finally managed to hit my target. So, as you can see, and the risk was actually about 41 pips. So 41 risk and a 95 target or 97. So more than almost a 2.5 to 1 reward to risk ratio. So this is more of an exception. With regard to trend trading, it is best to use a combination of time frames. It's good to use a higher time frame, maybe a 4-hour chart, for instance, to look for the trend, and a lower time frame, like an hourly chart, to look for retracement and continuation. This is a combination that I use most often: 4-hour trend, 1-hour retracement. But I don't think it's not the only one. You can use daily trend, you can use weekly trend, you can use hourly trend, and then zoom in one time frame lower to look for those pullbacks. So the methods I use are moving averages for trends, trend channels, and let's see, anything else. I use fractals. Um, I think that's probably the most popular things I use, most common things I use. Yeah. So for the trend, I like to use a 144 EMA close. I don't think using 200 is much different, but I like to use moving averages that are based on fib levels. I like to use a short-term moving average too, which you don't see on this chart, but it could be a 50, a 55 if you like Fib sequence levels, a 34, 21 if you like Fibonacci sequence levels. If you just want round levels, you can use 20 or 40, also fine. I think anything in there is good. Let's add one quickly. So we have two moving averages on the chart. You don't see it on this template because I don't want to make the chart too complex. All right. So I added a 21, and you can see actually that it's equal to the midpoint of the Admiral Keltner band. So, if you use the Admiral Market Keltner band, you don't even need a 21 EMA. You just have to, you can use the middle point, which is quite useful. You have two things in one. The Admiral Keltner band indicator is part of the MT4 Supreme Edition, by the way. So you can go to the website and download that for free and try it out if you like it, by the way. But let's leave this moving average on because you can see it a bit thicker with different colors. It's a special moving average that I use. You can send me an email and I'll send it to you. It's no problem. All right, there we go. Blue. Let's make it blue. So what I'm looking for in a trend is basically the moving averages to be aligned, and basically if price is retracing back to the 21 EMA, it could be a bouncing spot, right? And if it's above it, that means that it's impulsive, and I could, for instance, zoom into lower time frames to look for a smaller trade, right? So this is all retracement here. Retracement territory, retracement territory, retracement territory. These are all retracements, right? And if price is above it, so you have price above the 21, 21 above the 144, that in most cases is making a breakout or it's impulsive, and it's good to zoom into a lower time frame to see if there's any potential trade setups on those time frames. So when talking about specifically about retracements, it's good to see price go back to the 21 EMA, right? That's a good retracement. It's still a shallow retracement, but within a push like this, it's good. If we had a couple of those retracements happen, then you want to be on guard because at that point, divergence appears in the market, and there could be a bigger retracement occurring. So these small pullbacks are fine, but eventually price will break through them, and there will be a bigger retracement. So that's something you want to be on guard. So we want to be. My motto is trade with the trend, but also be realistic about how far the trend can go, and be on guard for reversals, but don't be too panicky about reversals either. It's not like they're happening every single minute, right? And if you're a reversal trader, then you might want to be even more patient before entering potential reversals. So this is perfectly fine. These kind of retracements a couple of times is great. Then you got deeper pullbacks when price goes back to the long-term moving average, like here, for instance, right? Or here. That's a bit of a different pullback. It's deeper, and that resets the trend more steeply. So those are fine too. I have nothing against when price is going back to long-term moving average, as long as the 21 EMA is not basically crossing or coming close to the long term, it's fine. And here we see that it does. So in that case, we have to be more cautious. It's still tradable, but we want to be on guard that there could be a correction starting, a range, or even a reversal. So it depends on the larger time frame, larger market structure, which side the breakout could occur is more likely. At this moment, of course, before the moving averages were aligned, so maybe an upside break is still more likely. The moving averages are a great help with many things, not only the trend, but the market psychology in general, and they are great support for my wave analysis, more than you might imagine. It's too complicated here to go through all the details about that, um, but they're very, very strong concept for understanding the psychology of the market. Together with the Osmo oscillator, they're really a great duo. So basically, the oscillator itself would also give retracements. For instance, here you can see strong AO reading, and then price just barely gets back to the zero line, gets back to the long-term moving average. So this indicates momentum upside, corrective downside. We can expect price to continue higher. These is the very quick way of looking at it, and I don't want to say it's that easy as it might seem. I don't want to paint a false picture, but you can do a lot with just these tools. With the AO, with the moving averages, simply looking for a strength when the price goes above the moving average of retracements, when it goes back, weak AOs as a retracement indication, and then look for continuations. So from that point of view, trend trading does not have to be necessarily complicated. All right. Reversal trading requires a bit more homework and a bit more work. Now, of course, at times price is going to be choppy. Look at this part. Here it's still uptrend, but here it goes into quite, a choppy zone. And at that time, it's probably good to move to a higher time frame, because if it's this choppy on this time frame and you're looking for trend setups, it is not a good environment. So it's often good enough it's better to zoom out, see the big picture, see what's going on, try to see if there's a trend going on other time frames, on higher time frames, or lower time frames, and see if there's a trade that would qualify with a trend setup. Lastly, if there's really no with the trend setup on this pair, other pairs, other instruments, other time frames, uh, perhaps there are other types of setups available. That's how I approach it. We can take a look at the dollar yen. Now, the dollar yen, basically, I expected a bigger correction myself. The trend itself is down when looking at price and the moving average. All right, but I expected a bigger reversal or retracement up to the R1, 111, or even further, the R2. That didn't happen, despite the pretty strong 1 hour candle here, right? It made a spike up and found a rejection, moved back lower. Went through the invalidation level here and continued with the downtrend. Kind of confirms the difficulty of trying to hunt for reversals. Shows that bigger retracements sometimes do not happen as planned. I myself was looking for an upside reversal or retracement. I was looking for a retracement. One more push up. Other traders that are perhaps looking on daily charts for reversals would have been seeing this, for instance, right? I spoke to a trader and he was looking at this. And I agree. It makes a lot of sense. You have bullish engulfing twins, right? At the S1, at 110 round level. So a lot of reasons to look for a retracement higher. One more bounce further upside. It didn't happen. Why? Who knows? Those things happen. They're part of trading. We got to accept it, move on, learn from it, perhaps if we can. If not, continue, right? But maybe, my friend was saying, could it be connected to news event about, let's say, the fallout between North Korea and the US? That that could create a risk adverse reaction, which is actually yen strength. Maybe it could be. Who knows? I really don't bother too much with looking for the why. Uh, I really don't invest time into that. But I think that the argument of my friend does make sense. It could make sense. Whatever it is, you can see the risk involved with trading against a trend, even if they're solid arguments. Very solid, I think. Engulfing twins, 110, support trend line, wave analysis that did favor one more upside. I was expecting this to be a wave one, two, three, four, and one more wave five. Sorry, one more wave five I expected. So this is a trend, sorry, a reversal that failed. Your dollar was a reversal that worked out. Now we saw examples of both. But yeah, those things happen. So trend is down. Could it continue? Yes, I think so. With the break of this bottom, I think it's possible. We can take a look at where the retracement levels could be. Let's add a short-term moving average. I wouldn't say that the break below 110 was necessarily very strong. Um, so we want to be still on guard for a rough bounce at 110. Sorry, it doesn't seem to be. Oh, yeah, we know that. I know what happened. Sorry. I didn't change the moving average number or value. Alrighty, so let's take a look at the hourly chart. 4 hours in trend, 1 hour chart. Looks like it could be in a retracement. I think the retracement is not finished yet. I would probably, before trading the dollar yen, would want to see the oscillator go back to the zero line like this, get a full retracement, and then wait for the turn. All right. Now, so far, we've only talked about like general ideas, like what is a trend, what is a retracement, what is a continuation, but didn't talk about specifics yet. So just to clarify, basically a trend is when the moving averages are aligned, there's space between the moving averages, and let's see, yeah, those are the two main characteristics. If the space is growing, then the trend is accelerating. All right. A retracement is when price in that scenario goes back to the 21 or 144 EMA. All right. And a continuation is when it pulls away from it again. So let me give you an example. Let me open my drawing tool. Does anyone else have a particular pair that they would like to look at after this one? So here the trend was up, right? You have moving averages aligned, price above it, and you have space between those moving averages. Retracements, oh, sorry about that. I lost my chart. Okay. Retracements are here, right? When price goes back to the 21 EMA. Okay? Or the 144, but it doesn't go that deep. Then here, the trend starts to become down. We get crossover. I'm not trading those crossovers, but it does indicate the trend change. So in this case, we have a trend, downtrend, right? Price making retracements to the long-term moving average, but also to the short-term moving average, right there. So that's just to clarify. And then the continuation is when price then uses those moving averages for further continuation of the trend. So moving averages are great for that. Basically, trend channels, trend lines, all of that could be used. Moving averages are easy because basically they're just automated. They automatically change per candle. Nothing has to be done. Trend channels, trend lines, we have to add manually. It takes some experience to draw the good lines. So it's good as an extra. I personally like moving averages more as a as the main tool. All right. Now let's take a look at the next example. Euro yen. Let me just change some of these values. Okay. All right. So just because the moving averages are aligned doesn't mean that the trend will continue. The moving average here are indicating an uptrend, and there has been an uptrend for a significant length of time. But we do also want to be realistic, as I said, with the trend. So we need to establish whether when price does move back to the moving average, short or long term, whether this is a retracement or a reversal. One of the things we can look for is divergence. If there's divergence present, then there's a good chance that price will go back to the long-term moving average. Therefore, the short-term moving average is not a good retracement spot anymore. On the euro yen, there is divergence between the tops. All right, we have clear divergence here between these tops. It's well, not that clear maybe, but a little bit for sure. So that means that this moving average I would not consider a retracement anymore. It was a good trend until price started to reverse here. Right? It was a good uptrend. Gave some good pips. Somewhere around here, I would say the uptrend started and has lasted. So good opportunities on lower time frames perhaps, but as divergence appeared between these tops, and these tops, this one and this one, and also on the 4-hour chart probably we had divergence between this top and this top, right? And even between these tops. So this was a double divergence because we talked about the fact that price here was probably going to bounce because of the divergence and the resistance top, right? Now eventually, price made a triangle and broke for one more high, but that actually created double divergence between these tops. So that's when, of course, trend trading becomes risky, and you don't want to trade with the trend. You either stay out, or you might think about reversals. When you have that many signs that the trend is in trouble, you can't ignore them, and you got to be realistic about it. So, spotting the trend is one thing, but we also have to make sure that the trend is not running out of steam. And the euro yen it did. And we're seeing a bigger reversal or retracement going on. So otherwise, if the divergence would not be there, right, then price has gone back to the long-term moving average. I know price broke below it, but if it's approaching it for the first time and breaking through it by a bit, that's okay. This is maybe a bit more than a bit, but roughly okay. It would still be considered a retracement. And I would be looking for continuations. In this case, not. Because of the divergence, I would not be considering that. What I would consider is if price gets on the daily chart way back to the long-term moving average, then the trend up might continue. What could happen is that price might be doing this. This moving average might fall a bit like that. This one goes up a bit like that. But if it bounces at the long term, right, this moving average will pick up again. And ultimately, this will stay an uptrend like this. So the larger trend is still up because of the moving averages that have good space between them and they're aligned to the upside. But does it mean that it's a good time to trade right now? No. But if we get a significant retracement, then it could still be good for a trend continuation. So we have to, the first step is to see if there's a trend available The second, to see if the trend is still alive and viable and not running out of steam. And then to see what kind of spot could be good for a trend continuation, if at all, if there's any at all. And then to identify that retracement, wait for that retracement level, and then of course try to wait when the price gets to that retracement level, look for confirmation candles at that level, look for bounces, candlestick patterns. So for instance, if price were to make a downside like this, show engulfing twins here, that would be a confirmation of a bounce and a retracement, finishing a retracement. And then a continuation could be the engulfing twin or the break of the engulfing twin, break of the trend line as it continues back up again. So let's, this is unfortunately because it's working with the future. It's not really good scenario because we don't know how, we have no practical examples. So let's take a look at some past examples to make it a bit more concrete. Once again, we're looking for trend continuation, trend retracement continuation. So let's see if we can find an example in this downtrend. I think there should be plenty of material for this downtrend, right? So let me zoom in so you can see it a bit better. So here you see the moving averages being pulled apart, price going back to the long-term moving average, right? So trend is down, right? Price is making a sturdy retracement. So what could the continuation look like? And these are various ways to trade it. This is a very general concept. There are very many ways of trading it. Candlestick patterns is one of them. You can use fibs, many tools to discuss it. We talked about some of them in the past. One of them could be Keltner, for instance. And you can see that there's besides the long-term moving average, there's Keltner. I myself use a system that is called SWAT, for instance, and that helps me with color codes and signals to look for entry. It's more automated, right? Auto traders might be using trend line breaks. There are many ways how you can trade these particular patterns, right? Trend, retracement, continuations. But the webinar we have to kind of focus on and drill down a bit on one area. It doesn't make sense to mention 500 things. So my favorite, once again, moving averages, and you can see why. Trend, pullback, continuation. So how do you measure the continuation? One of the ways we could choose is price action, right? Looking for failure of this high or a strong bearish candle. So when we look at this formation, at what point would it be good to trade? Well, we have a strong bullish candle, so definitely not this doji. Not even these smaller candles in this doji. I think that those do not indicate much. They indicate a pause. From a price action candlestick point of view, we don't have a lower high, but the next candle, this one, right here, is a bearish candle. It's breaking below the lows of all those candles. It's a sizable candle, and I think it is a decent candle to trade this bounce. Now, this is a bit difficult scenario because you do have a massive bullish candle, and that's not easy to trade. But I think that considering the structure of the market, the downside trend, where are we? I lost my bearings here. The downside trend, right? The retracement, the failure to break this high, a fractal, I think that this candle could be worth it. So eventually, after a few days, price starts to move more. After 2 weeks, it starts to fall quickly. So we're using price action for a confirmation of the bounce could be one valid method. Another valid method could be to zoom in to lower time frames. Let's take a look. There we go. Alrighty. So on a 4-hour chart, for instance, we could wait for the trend to be aligned, which happens here, right? And we can trade breakout, or we can trade the bounce here, right here. Those are different ways. On a 4-hour chart, we might decide to trade the counter break like this right here. So there are a lot of ways that we can try to trade a continuation besides candlestick patterns. We can zoom in, look for trendline breaks, for instance, look for a trend to be aligned. The cool thing about this concept is that basically there are a lot of ingredients that you can combine. It's like cooking. You know, you have a rough recipe, but you can throw in the ingredients that you think you can change it each time. Not everyone does that. You know, though some people like to follow a strict recipe. Those are more signal hunters. You have people who are more looser in their application of the recipe. Those are more manual traders. Those are more traders that like to learn and think about how the market is moving. Both are possible. Both have their own ways. But I like the beauty about using trends, pullbacks, continuations, is that it gives you kind of the freedom to apply the tactics basically as the market in the situations that the market is different. You know, it has a different footprint, has a different setting each time. So by using these concepts, we are flexible enough to change to set up a trading plan that is adjusted to how the market looks like now, if you see what I mean. So yeah, that's about it regarding moving averages. Another great tool for pullbacks, of course, is fibs. So let's take a look at that back on this chart. So if we see a trend and there's no divergence present, of course, we can put a fib like that. And you want to be on guard for these fib levels. Those are typical levels where price can bounce and continue with the trend. So if you see, you know, some strong pattern there, yes, that helps with the trend trading. If you see here, for instance, a 61.8 fib, that helps. It's a bounce at resistance right there, right? So moving averages are great for deciding the trend and retracements. Fib levels help identify more exact turning spots of the trend. I should say, not turning spots, continuations of the trend. They're like discount levels. And candlestick patterns, once again, could confirm the reaction to the fibs, moving averages, etc. So for instance here, price is trending, moving averages aligned, space between moving averages, price is retracing, right? Hits the 50 fib bounce, hits the 61.8 fib bounce, and that is the one that sends price down lower. Right, so the Keltner and the 61.8 fib give confluence to a bouncing spot within the trend. And these are great. These retracements within the trend are great, and they're a big help with finding a good discount. It's not only a concept that can be used on the daily chart. You can take a look at the hourly chart, for instance. Let's just scroll all the way forward. All right, there we go. 1 hour chart, we see that the trend is down. Now we know that the 4 hour is still neutral, but 1 hour definitely down. So we can put a fib from this top to this bottom. All right, no divergence on this 1 hour chart. So I think there's a pretty decent chance that price will continue. Just waiting for this pullback to finish. Let me take a look at the lower time frames. All right, there we go. So I think any of these fibs could be a turning spot, right? Price does not have to go to the long-term moving average. And looking for some 4-hour candlestick pattern at the 50 or 61.8 fib, I think has a decent chance of finding resistance, right? And making a turn back to test this bottom and perhaps lower, perhaps even further. Let's see if there are more trends going on at this moment. Um, Pound dollar is retracing, for instance, right? It's trending, but is also retracing at the moment. You see the pound dollar has divergence between the bottoms. It is only a single divergence on the hourly chart, but therefore I would be expecting a price retracement back to the moving average, long-term moving average. So if price does that, I think that you can see also the 4-hour divergence between these tops and price going back to the long-term moving average. So the main target for the moment has been hit. But I expect more bearishness based on the impulse that we see here. We can see a trend in any case. You can see price aligned, moving average aligned, and I would be interested in trading it if price makes a deeper retracement like this back to this resistance zone. And I think that that could be the spot where the trend continues. So trend is down on the hourly chart. 4-hour chart is still up in the air. And price is now making a retracement within this downtrend. If it finishes the retracement, I think it could be interesting. On New Zealand was something that I was interested in this week. All right, let's take a look at this 4-hour chart. You can see that the price had broken out. All right, had broken out, had gone back to the long-term moving average, bounced. The moving averages are aligned to the upside, so it's an uptrend. Once price bounces and breaks, price is back into the uptrend. So potential trades in this candlestick pattern at the long-term moving average, the breakout, but also as price makes a break, pullback, continue, right? It was also still tradable at the continue part, right? Right here, for instance, the 50 fib, that could have been a retracement within the trend as the trend is aligned to the upside. You got the moving average aligned, and price is going back to the 21 EMA. No divergence between these tops, so there should be potential for upside. All right, so from this point of view, that could have been a trade, right? But I took a trade even on the hourly chart. I saw price basically making like this momentum, moving average being pulled away, and you had a move back to the short-term moving average. So what do we have here? We have a 4-hour chart that's an uptrend, right? We have an hourly chart that's an uptrend. We have price breaking resistance and moving up with impulse, right, as an extra. And we have price then hooking back to the short-term moving average. That is a classical example of a pullback retracement within a trend. Clearly trend established. We have a pullback to the moving average. We don't have divergence. So the short-term average is a valid support level. If there, once again, if there would be divergence visible, available, then we wouldn't expect that. And we would expect price to go back to the long-term moving average. So what happened? I took the bounce, right? And was aiming for the targets that I use by using a fib and my whiz tool, like this, minus 51.8 target. Stopped at the minus 272 target. That could have been a target as well, or the minus 61.8 target. And the trend continued for one more push. So that's a classical example of basically a trend, pullback, and here the continuation. So these types of patterns, these types of motions or movements within the trend, I think are basically my strongest setup, my strongest way of trading. I use wave analysis to support that analysis, market structure, and basically I quickly scan the time frames looking for the best trends, focus on the ones that are best trends, then zoom in, look for pullbacks, and take the setup if it's available. All right, so this is my favorite way of tackling the market. So let's take a look at gold. Angel's talking about gold. And yeah, gold is moving up. Kiwi and Aussie were moving down. And Angel is referring to the fallout, as I mentioned, between North Korea and US, impacting the yen strength, impacting here gold strength, as there's maybe a risk off sentiment because of that. And that's possible. And probable, I think, in this case. Once again, I don't look really at why that much, but I think that that is very plausible. I think that I was expecting the gold to retrace at least to the 50, 61.8 fib before continuing. This was a very shallow retracement. It didn't even hit the 38. I must say that from a price action point of view, it was a bit choppy. When you look at, I was already saying yesterday, like strong ups, but also strong downs, but also strong ups, right? So it's very choppy. But I expect the price to continue in this channel down to 1230. That hasn't happened yet. Why I expected that was because I have 5 waves here, like this, and I expected an ABC. In theory, it did finish an ABC, but obviously I expected the ABC to go deeper. Now, I'm not sure. I think that, honestly, I think that this is probably still a wave 4 in that case. This is a wave 1, 2. This was a wave 3. And I think that this could still be a wave 5. The wave 5 could go up to 1292, for instance, right? And the previous top. And it might make a fifth wave, and I would still expect an ABC. I'm maybe a bit stubborn on that, and then an upside. Let's see if that happens. Alrighty. Sorry, it's my keyboard has a letter that gets, or a one of these symbols that gets stuck, and it's making a command that I don't want to do. So sorry for that. But so that's my view on gold at the moment. All right, folks. Let's take a quick look at admirmarkets.com for more analytics, more education. We recommend to take a look at these 2 tabs, analytics and education, platforms, the instruments, how to start trading. You all have it here. You can find it here. We look forward to seeing you tomorrow. We're going to take a look at some money management techniques, and we're going to look forward to seeing you in those webinars. Next week, we're going to take a look at strategy again. I'll be talking about the trend channels. Within the trend, I'll be talking about fractals and continue with those concepts, how you can use that for trend. Today, we're talking mostly about the moving averages. I wanted to start with that because from my point of view, it's the most powerful tool. It's my favorite tool. and it's really good for understanding the market psychology. So, from my point of view, very important. But we'll talk about, as I said, fractals, trend channels as well for trend trading. After that, we can maybe talk, we have a couple of webinars to go, so we can maybe talk about trading pullbacks and breakouts a bit more in the week after. There are some couple of questions. Angel, is asking me, do you think if gold closes today under 1271, it will go again down? All right, so I cannot show you. It seems that somehow my chart is a bit frozen here. So let me quickly look at my other chart here. $12.71. 1271 is not that bearish of a close. I think that the daily candle at this moment is open at 1260. The high is 1276. So it has to be a pretty substantial wick. We're talking, I would say, about 2/3 wick. So if it's a $16 candle at the moment, or I should say, yeah, then 2/3 is about 10. So it would have to go below 1266 for me to see it as a rejection of a substantial order. Otherwise, it's not really that weak of a candle. If it closes anywhere where it is now at 1273, it's actually a pretty strong candle close. Strong bullish, relatively okay or strong bullish candle, and I would expect more continuation of gold to come out. That might not happen. I might be too optimistic about gold, but considering this upside, I think it probably will continue up to 1296-ish, right? 1295. That's my view. So let's see. Today's candle will indeed give some information. It's just that it would really have to fall a lot before I would consider that a failed daily candle for the upside. Nenet's still around, and he will be here next week, and even the week after, I think. End of August, he will not. He'll be on a small trip out and won't be having his webinars. I think 2.5 weeks from now or something like that, or 2 weeks and 1 day or something like that. So, folks, thanks, traders. Thanks for joining this webinar. We're looking forward to see you soon. Wish you all great trading, and I hope to see you in one of these webinars tomorrow. For instance, we'll take a look at some money management techniques. Looking forward to that, and see you all soon. Cheers.